Hello everyone, I hope that you guys are doing great and I hope that your preparation is also going well up till now, and most probably I also hope that the materiality which we discussed within the previous lecture, which was discussed within the previous lecture, which you have already taken, is something that has been properly understood by you, because this is very important for the exam. Again and again I've been repeating this within the previous lecture as well, that materiality as a whole is one of the most important thing within the audit exam, because materiality is tested within many different places. If you properly understand materiality, then it is guaranteed that you understand the concept of audit, because understanding the concept of audit means that you should understand why every single small mistake does not lead to the fact that auditor is saying that the financial statements are not correct. Why doesn't that happen? In order to understand this, the concept of materiality becomes very important, and we have covered this within the previous lecture. So if you haven't taken that lecture, I would recommend you and I would urge you that before taking this lecture, you should first take the lecture of materiality, which is the previous lecture. Unless and until if you don't take that, then you would never be able to understand what we are about to study right now. So, moving towards the next thing within this lecture, the concept, or now what we have to study, is performance materiality. Now, what is performance materiality? In order to understand this properly, again, I'll have to go to my explanatory notes and I will explain it here. What is performance materiality? What is performance materiality? Performance materiality as a word is very difficult to understand, because materiality is something that you already know. You have studied it. You know the RAP model. You know what are the things that are material by nature. You don't need to use the RAP model for them to determine whether they are material or not. In other words, whether they are important for the financial statements or not. But when you add the word performance materiality, what is meant by this? So during the audit, let me bring up that example first of all, which we studied as well within the previous lecture. I'll bring up this example. Okay. So let's say I copy this example and paste it here as well. So this is the example. Let me clean it up now. So let's clean it up. Apologies, this is taking a lot of time, but you have to bear with me for a moment, because example is something that I will continue to use within the next lectures as well, because your basic understanding is based upon this example, right? So I want to use this example to make sure that you understand every single thing. All right, now. So this is 70,000. This one was 70,000. This is 10,000. This is 60,000. This is 20,000. This is 30,000. This was the first part. And cash was, let's say, 40,000. Yes, this was the example. Am I missing something out? Let's check. No, the cash was 40,000. So what did we determine the materiality for this specific question? By using the RAP model, we determined within the previous lecture that the materiality which we are going to use is $50,000. So anything above $50,000 is something that must be corrected by the management. And further within materiality, we also discussed that in the aggregate, we have to check everything out. All the errors combined together, the things that haven't been corrected by the management, are all those errors combined below materiality or not. So if they are above materiality, unless and until the aggregate amount is below materiality, we still continue and tell the management that you have to correct it. You cannot ignore this, right? This is what we do. So this was the materiality which we used within the previous lecture. Now let's move towards the concept of performance materiality. In the context of performance materiality, I'll simply write down PM. So what the auditor does within their practical life as well, and by the way, within your lectures or within your syllabus, calculating performance materiality or determining something based upon performance materiality or scenarios linked to performance materiality, no. Under the course of AA, under the syllabus area of AA, you only need to understand the definition of performance materiality. And in order to understand performance materiality, this is the example that I'll give you. Then we will move towards the definition, because definition is something that you will have to learn. But what is performance materiality? You can only learn it from this specific example that I'm about to give you. Performance materiality basically means that the amount of materiality is reduced. So if your materiality, let's say within this question, is 50,000, Auditor within the practical life will also reduce the performance materiality, will reduce this materiality, let's say to 45,000 or 40,000, or he can reduce it to 30,000, whatever the case is. But performance materiality is based upon this amount that you have already selected, and you further reduce it down, you refine it down to calculate even a lower amount. Now, there is no guidance within your syllabus, within overall ISAs, within overall standards which state how performance materiality is calculated. There is no standard available within your practical life as well linked to international standards of auditing how performance materiality is selected. No standard is given. But every single firm has their own criteria to determine performance materiality. I can give you the example of EY. I can give you the example of Deloitte. I can give you the example of PwC, I can give you the example of KPMG, because these are the firms that I have been somehow linked with. And I understand how they choose their performance materiality. So every single auditor, every single firm has to choose a materiality amount. And how do they choose it? They choose it using the RAP model, RAP, revenue, assets, total assets, and profit before tax. 0.5%, 1%, and then 5%, the lower levels. We only talk about the lower levels within our course, forget about the higher levels. So then what is this performance materiality used for, by the way? And how is it determined? I said that every single firm has their own criteria to choose performance materiality. What does this mean? For example, EY uses 55%. EY uses 55% as their performance materiality. Now, what does these percentages represent? I'll let you know at the moment. Deloitte uses 60%. PwC uses 50%. KPMG uses 75% as performance materiality. Now, what does this mean? This means that whatever materiality has been calculated by you, multiply by this factor, multiply it by the amount that you want, multiply it by the percentage on which you want to set your performance materiality at. So for 55,000, I'll give you the example of KPMG. If we multiply 50,000 by 75%, let's do it. So 50,000 multiplied by 75%, 37,500. 37,500 USD is my performance materiality. This is how performance materiality is chosen within the practical life. For the exam, you don't need to know how performance materiality is calculated, what are the percentages we use for performance materiality. The only thing that you want to know is that, and you want to remember, is that performance materiality, the amount of PM is always below the materiality. The amount of PM, the amount of PM is always below M, materiality. Why? Because performance materiality is based upon the materiality. First, you have to calculate materiality using the RAP model, and then you calculate the PM based upon the materiality you have calculated. So performance materiality is always lower than materiality. Now the question in your mind is very important. Sir, we have already calculated materiality. We are identifying all the errors within the financial statements and amalgamating them, aggregating them, and then telling the management whether they have to correct it or not based upon materiality. Why do you always have to bring up something new, sir? We are already already over our mind. We are trying to remember so many things. Then why do you have to state this extra thing that what is performance materiality? I know you have this question within your mind, but give me a second. I'll make it very easy for you to remember. The thing is that when we talk about financial statements, so let's make a financial statement in front of you. Let's say a company has non-current assets, then they have current assets, then they have non-current liabilities, and then they have current liabilities. Within current assets, they have property, plant, and equipment of, let's say, $200,000. They have current assets, they have receivables, inventory, and so on and so forth. Let's say 100,000. Let's give the inventory an amount of $50,000. For non-current liabilities, let's say the amount is, first of all, let's talk about loan, LOAN, loan. Loan is an amount of $100,000, and in current liabilities we have payables. This is the usual financial statements, and the amount of payables is $50,000. Now try to understand this fact that these financial statement, the statement of financial position added with statement of profit and loss, P&L, when we choose materiality, When we choose materiality, materiality is the final step. Always remember that materiality is the final step. An auditor is a very, very fearful person. Auditor is like a person that is always fearful that something bad will happen. So they always try to take extra steps to ensure nothing bad happens. And in the world of audit, what is the ultimate bad thing that can happen to you? What is the ultimate baddest thing that can happen to you? You giving an inappropriate audit opinion. And what is meant by that? You stating that the financial statements are correct, whereas there are errors within the financial statements which are above materiality. That is the major issue. That is the ultimate bad thing that can happen to an auditor. And when an auditor wants to protect himself from the fact that this bad thing can happen, this risk can arise that we can give an inappropriate audit opinion, he does it in multiple steps. Performance materiality is one of those steps. Performance materiality, what did I say? Materiality is for the both financial statements as a whole. The step before materiality is performance materiality. Why? Let's say my performance materiality is 37,500 and my materiality is $50,000. What the auditor will do is that during the audit, he will ignore materiality at all. He will say, okay, I have calculated materiality. I know what is the amount of materiality, but for now, let's ignore materiality. Let's just ignore it. We don't need to remember it. We will remember it again at the end of the audit. He will only remember the figure of performance materiality. What he will do is that he will audit property, plant, and equipment. Then he will say any errors within property, plant, and equipment which are above or in the aggregate, above this performance materiality amount, I will let the management know. I will let the management know that you will have to correct it. For every single head, when he is auditing every single item, these are known as these separate items are known as line items. In the world of audit, in the world of financial statements, these are known as line items. Whenever the auditor is auditing every single line item, he says, I will ignore the amount of materiality for now. I'll move with performance materiality. So any error within this specific head above this amount, I will have to let the management know. They have to correct it. Any error above this amount, I will have to let the management know again that they have to correct it. Any error above this amount, not in the aggregate. I'm not talking about in the aggregate. I'll audit this separately. So any errors, let's say within PPE, I identified an error of $10,000. One error was there of 10,000. One error was there of $20,000, and one error was there of $40,000. First of all, the auditor will ignore the concept of materiality and only use the amount of performance materiality. He will let the management know that this amount is above PM, you have to correct it. The management will correct this amount. Then the auditor will again, within PPE, not moving to any other line item right now, within PPE itself, the auditor will again calculate both of these and say this is below the PM which I've selected. The total of this amount is 30,000. So for now, I can ignore them. But he will make a list. He will make a separate list. He will make a list uncorrected misstatements. Uncorrected misstatements. In PPE, we have two misstatements. One is $10,000 and the other one is $20,000. All right, let's move to the audit of the next thing now. This was within PPE. And any error that was above this amount, management has already corrected it. Management has said that we are going to correct it. So this error is no more there within the financial statements. So you can ignore it. But all the uncorrected misstatements, the auditor will continue to make a list of it. Let's say the auditor also audited loans. Again, when auditing the amount of loans, he identified that within loans itself, there is first error of $10,000 and then there is an error of, let's say, $40,000. And again, specifically for loan, again, he will use the amount of performance materiality. Performance materiality was 37,500. The auditor will tell the management this amount is above PM within this line item, specifically within loan, this line item, you have to correct it. The management will correct this within the financial statements. Then the auditor will again look at this amount. This amount is below PM. We can ignore it for now, but we will include it within the list. Again, loan. The first error is that is uncorrected at the moment is this one. He will do it for every single line item, and for every single line item, even within statement of profit and loss, he will audit every single line item. Revenue will be audited separately, cost of sales will be audited separately, expenses will be admin expense, other expenses will be audited separately. Checks will be audited separately, and for every single one, whatever error you identify within those heads, within those line items, you will use performance materiality within your practical life. Now, he will let the management know that any amount above performance materiality has to be corrected right now. Remaining are the amounts which are below performance materiality. We can ignore them for the moment. Let's just ignore them for the moment. And the auditor will start making a list of them just like this. Once the audit is complete, all the financial statements have been audited properly by the auditor, all the errors which were above performance materiality in every single line item, they have been corrected by the management. Now basically the auditor is finalizing the audit. During the finalization stage, he will now ignore the word performance materiality. He will ignore it. Now he will remember back again what was the materiality we calculated at the start of the audit. The materiality was $50,000. He will now again look at these uncorrected misstatements, uncorrected errors within the financial statements and identify, is any of this error above the materiality amount individually? No, this is not above it, this is not above it, this is not above it. We can ignore it, right? Let's say we identify two more errors within payables. Payables, there were two more errors. The first error was for $20,000 and the second error was for $30,000. All of these errors individually were below performance materiality. Those who were above performance materiality, the auditor let the management know, please correct them. Otherwise, I'm going to state that your financial statements are not correct. So the management, under pressure, they started correcting all of the errors, right? The management said, all right, these are above PM, we are going to correct it. But now all the combined list of uncorrected misstatements which were below performance materiality has been made by the auditor. Now he will forget about the amount of performance materiality and again remember in his head what was the materiality we calculated, and he will start comparing all these errors with the materiality amount. In these cases, none of these amounts are above materiality. But now he will look at them aggregatedly. He will aggregate them all and check whether all of these misstatements combined are above this materiality amount or no. The auditor will add all of these up. So 10 plus 20 is equal to 30, plus 10 is equal to 40, plus 20 is equal to 60, plus 30 is equal to $90,000 total aggregated misstatement right now, uncorrected within the financial statements. Aggregated misstatement. This is the amount of aggregated misstatement within the financial statement, which is above materiality. The auditor will let the management know, listen guys, I'm not a fool and neither are you. You know how we do audit. Your company is being audited for the last 10 years. All of these amounts combined are above materiality, and these are all the errors. All of these errors are above materiality. So if you don't correct them, we will specifically state within our audit report that your financial statements do not give a true and fair view because you have material misstatement within your financial statements. So the auditor will let the management know you need to at least adjust $40,000 of errors from these. So the management, you discuss with the management will state, okay, let's correct this error and let's correct this error. Both of these errors have been corrected. All the remaining errors combined now, aggregated amount is $50,000, which is equal to materiality. Again, you will let the management know, nah, boy, nah. Equal to materiality is also material for us. So you will say, if you don't correct one more error, unless the amount is 49,999, we will still state that the financial statements are incorrect. We will not agree with you. The financial statements do not give a true and fair view. This is what we will write within our auditor's report. So the management, again, you will let the management know, correct this error, please. So management corrects again the $10,000 worth of error. All the remaining errors combined, all the two, this one, the first one, and the last one, amounts to $40,000. Now the auditor will look again at it and compare with materiality. It is below materiality. The auditor will say, all right, now the financial statements give a true and fair view. There is no error within the financial statements. But why still use performance materiality when all of this could also have been adjusted within materiality? Why? Because even if you did not use materiality, still only summed up every single thing and made a huge list. At first, you'd never let management know that what are the errors. You just start making the list. You ignore performance materiality. And at the end, you let the management know these are all the errors which are above materiality. Please correct them. That could also be fine, right? You are thinking in your mind, then why still the auditor uses performance materiality? It is of no use. Literal no use. You can say this is literal bullshit, an extra work that you have to do within your practical life. But the thing is that I told you at the start of this lecture, the audit field is very, 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 very Very difficult. Why? Because thousands upon millions of investors rely upon your opinion that whether these financial statements are correct or not. They rely upon that. And if you state that the financial statements are incorrect, they will not invest in the company. If you say that the financial statements are correct, they will again base their decisions based upon the opinion that you have given. And if opinion regarding the financial statements are incorrect, then your reputation as an auditor, as an audit firm, will be hurt badly within the market. And you cannot allow that to happen. In order to protect yourself, when you are auditing one single line item at that specific time, at that specific area, you also calculate a lower materiality, which is known as performance materiality. So exactly at that time, you can still let the management know that this error has to be corrected. At the end of the audit, there is a very high chance of error that you may miss something out within this specific file that you are making, within this specific list that you are making. You might miss something out. You cannot rule out the human error from within the audit field. Human errors happen within every single field. Even when planes are being developed, there is a chance of human error within that field as well. That is why planes do crash, right? If there was no human error, why would planes crash? Human error is present in every single field. In order to reduce that human error within the practical life as an auditor, whenever you are auditing one single line item, you always use performance materiality. So when you even further reduce materiality, even smaller amounts then get adjusted within the financial statements. So at the end, all the list that is remaining, none of the amount, even individually, is above materiality. Only you will need to look at them in the aggregate, sum them up and look whether all of them are above materiality or not. This is why we use performance materiality within the auditors use them within their practical life as well, to reduce the risk that during the audit we don't miss something out. If we are only basing every single thing upon materiality, then there is a high chance of human error, even in your life as well. We always use the term, never put all of your eggs within one basket. Never invest in one industry. Never put all of your investment in one company. Why? Because if that company goes out, all of your investments are done. If one basket falls down, all of your eggs would break. So that is why the term is used within practical life as well. Never put all of your eggs within one basket. Just like that, as an auditor, never rely upon one control. This materiality is a control as an auditor. For the auditor, this is a control. What is the control here? That none of the errors go unnoticed, which are important for the users. Above this amount, everything is important for the users. And if you are only correcting amounts at the end of the audit, there is a high chance that you will miss something out. That is why we always use a lower amount during the audit, which is known as performance materiality. It is based upon materiality so that chances of errors within the field of audit are reduced. During the audit, majority of the misstatements will be corrected by the management. Only those which will be remaining will always be below the materiality amount individually. Only you will need to look at them in the aggregate, and then let the management know in the aggregate it is above materiality, you will have to correct it. That is the reason why performance materiality is used. Now, for the exam, overall, for the exam, you don't need to remember how performance materiality is calculated. You don't need to remember that. The examiner will never ask you a technical question where he asks you how performance materiality is calculated, or he will give you materiality and then ask you what is the performance materiality for this question. No, that is not going to happen. In the exam, you will only need to calculate materiality, and your answers will only be based upon materiality. The concept of performance materiality is purely theoretical within your AA syllabus. It is purely theoretical. Nothing is linked with technical portion of the exam. So you only need to remember the concept that performance materiality is always below the materiality amount. It is always lower than the materiality amount. And the auditor uses it during the audit, not at the end of the audit. The auditor uses it when he is auditing every single line item within the financial statements. Coming back towards our clean notes, let's read the definition now. So, during the audit, the amount of materiality is reduced even more for every single line item in the financial statements to reduce the risk. This is the example that I've already written within these notes as well. Obviously, when I share these notes with you, you can see them, you can revise them. But the definition that you need to remember for performance materiality for your AA is this one. Performance materiality is the amount set by the auditor at less than materiality for the financial statements as a whole to reduce to an appropriately low level the probability that the aggregate of uncorrected and undetected misstatements exceeds materiality for the financial statements as a whole. In short, this definition means that when you set a lower amount of performance materiality to correct errors during the audit, the chances that individual misstatements are above materiality, this is reduced. So during the end of the audit, you only need to check those errors in the aggregate. Because if you are correcting all the big errors, even $40,000 errors, which are basically below materiality during the audit, but if you corrected it because of performance materiality, this means that this is no more within the list. Anything that would have been individually near materiality would already be corrected by the management. Only amounts which are very, very far away from materiality are remaining. So you only need to check in the aggregate during the end of the audit whether in total materiality, the uncorrected misstatements are over materiality. So that is the reason. The auditor sets performance materiality at a value lower than overall materiality and uses this lower threshold when designing and performing audit procedures. Even within your, what do you call it, softwares that you use for auditing, sampling softwares. What did I say? Sampling softwares. Even within these sampling softwares, when you enter the amount of materiality, you always enter the amount of performance materiality. Because if you are entering $50,000, then the software would take a low number of sample for you. If you enter a lower amount of PM, then the software would automatically take a higher number of sample for you. Because of this, you also test more things during the audit. So the quality of the audit is also increased. This reduces the risk that the auditor will fail to identify misstatements that are material when added together. That when added together, even when added together during the stage of performance materiality, majority of the errors would have been corrected by the management. At the last stage, only minimal errors would be remaining, which would be compared against the total materiality, which is for the overall financial statements, and any error there, which is above materiality, would automatically be corrected by the management. This is the concept of materiality, and for the exam for materiality, obviously you need to remember how it is calculated, what are the things that are material by nature, you need to remember them. But for performance materiality, you only need to remember and learn these things. Learn these things. And now learning would be even easier for you because I have explained it conceptually for you that what is PM, why is it reduced. Now you have a very clear concept within your mind. So now let's move forward towards the next area. Now, the next thing that we have to study is professional skepticism. What is meant by the word professional skepticism? In order to explain this, we don't need to go towards the rough notes again. This is a very simple concept which basically states that as an auditor, you have to be skeptical about every single thing during the audit. This means that you have to question every single thing out. For example, you are auditing revenue at the moment for a company. And during revenue, you go to the management and you ask them to explain to you how revenue is recorded, what are the different types of products that you sell, what are the different things that you do to generate revenue, what is your profitability ratio, how to which customers is this sold to. Whatever the management is explaining to you, let's say the management says, okay, we sell socks, we sell ties, we sell shirts, and we sell pens. These products are sold to distributors and we have total 3 distributors. Distributor number A, distributor number B, distributor number C. These are the 3 distributors that we have. And approximately all of these distributors further sell to the different shops that are within the country. And this is how we generate our revenue, right? If the management is explaining you something, you always, wherever during the audit, every single time, whenever you rely upon something, you never rely upon it. You first question it. Is this thing even correct or not? This is known as professional skepticism. So let's come to back towards our scenario which we just made. If the management is explaining to you how revenue is recorded, or where do we sell our things, what do we make, how is revenue recorded, you don't simply rely upon the management and agree with them, all right, so this company, you basically don't agree with them that this company sells ties, shoes, this, blah, 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 and these are the 3 distributors. You simply don't rely upon them. No. First, you have to check it out whether they are even telling you the truth or not. Because if you simply rely upon them, then this means that you would rely upon anything that they tell you. And if that is the case, even if there is a fraud and management tells you no, there is no fraud, still you will rely upon them. Nah, that can't happen. If you don't trust someone, then you can't rely upon them, right? You can't trust them. If whatever they are telling you, you second check that thing. You always check whether they are lying or not. The same is the case as an auditor. Whatever management gives you, whatever explanation management gives you, you have to check it first. This is known as professional skepticism. So how would you check the concept of revenue in this case, the scenario? If management is saying we sell ties, then there must be invoices which mention that 100 ties were sold or 200 ties were sold. If the management is telling that we also sell pants or shirts, then there must be different invoices which state that 100 shirts were sold or 100 different pants were sold. This is, you always second check to ensure that whatever is being told to you, whatever is being given to you by the management, is that thing even correct or not? So if the management, let's say you ask the management that please show us invoices where it is mentioned that you sell ties. Management shows you those invoices. Would you simply rely upon them? Nah. Management could make the invoices themselves and show you, see, we have sold these things. You can't simply rely upon these things. You will always look for what? An evidence which shows that yes, these things have been sold to this distributor. That distributor would have signed on this invoice or would have signed on the good received note that the goods have been received by the distributor. You always let the management know, okay, this is invoices. This is the invoice. On this invoice, it is mentioned that you have sold 100 different shirts to this distributor. Please show us a signature of the supplier, or sorry, the signature of the distributor number A on the good received note that they have received it. If the management shows you that signature on the goods received note, this means that they actually sell those shirts. As an auditor, whatever is being given to you, you cannot rely upon it directly. You always have to second check it in one way or another way. This concept is known as professional skepticism, that always question things out, whether they are correct or not, whether they are true or false. So, coming to the concept of professional skepticism, professional skepticism is an attitude that includes a questioning mind, being alert to conditions which may indicate possible misstatement due to fraud or error, and a critical assessment of audit evidence. So basically, again, this means whatever is being given to you, whether it is an evidence, whether it is an invoice, whether it is anything, whether an explanation is given to you by the management, never simply rely upon it. Always double check it to ensure that whether that thing that is being given to you, is it correct or not correct. This is the concept of professional skepticism, or in other words, always have a questioning mind if you want to be an auditor. Never rely upon anyone. Always be that person that always questions everyone out. Always be that person within the field of audit. Now, a lot of the auditors that you will meet within your practical life as well, like me, like someone else, who you will meet within your practical life, and if you tell them something that this is something happened to me within my practical life and I was also surprised, you're telling them a story, you will always feel that that person, because he is an auditor, he's not directly relying upon you. He does not believe you directly. You will always feel that that person is went on and asked someone that, my friend told me that this happened to him yesterday. Was it actually true or not? Did you see it actually happen or not? That person, not only within their practical life, not only in their professional life, they will have a questioning mind. They will be professionally skeptic person. Even in their personal life, they have so much training within their audit field that even in their personal life, you will always see that they are skeptic of everyone. They always second check or question every single thing that is happening within their personal life as well. Because this is the training of an auditor, that you can never rely upon anyone. You will always have to question everything out, and you always have to raise your hand to double check everything. Now, professional skepticism requires the auditor to be alert to four different things. Number one, audit evidence that contradicts with other audit evidence. So let's say the management gave you the invoice that, see, we have sold shirts, but they are unable to make a good received notes which their customer has signed. So this evidence is contradicting with this evidence. On one side, the management's invoice is saying that yes, see, we have sold things, but on the other side, they are not able to generate any kind of evidence for me that has this thing been actually sold or not, because they can make invoice on their systems and just simply print them. They can sign it themselves as well. So I need a customer's signature whether these things were received by them or not. So one evidence you may find in your practical life and within the scenarios as well, within the questions, that you might find one evidence that is contradicting with other evidence. As a professionally skeptic person, you always need to have open eyes to identify these things. Number two thing, information that brings into question the reliability of documents and responses to inquiries to be used as an evidence. For example, you have properly completed the audit at the moment and you have found out that this company is a very good company. They have made no mistakes within the financial statements. And before giving the audit opinion, before issuing the auditor's report, you find out that there was a news about this company that the CEO was involved in a big fraud. All of the audit that you have done, you never found out anything. But now there is a news in the market that this company is not a good company. So doesn't this mean that again, this specific thing that has happened within the market is telling you that nah, your audit might not be correct? This is the second case. Number three, conditions that may indicate possible fraud. So always have an open eye to identify that there may be fraud going inside the company, even if the company is a good company. Even if you have been auditing the company for the last 10 years and you know that like this is a very good company, still during the 11th year audit, 12th year audit, 20th year audit, every single audit, you always need to have an open eye to identify and to look for fraud, that whether any kind of fraud has happened within the company, try to identify it. Next one, circumstances that suggest the need for audit procedures in addition to those required by ISA. So, for example, you found out that the invoices that are being generated by the management are not correct information. The management is themselves making them, forging these documents basically. Actually, they haven't sold anything. So all the procedures you have performed which were required by the ISAs to obtain this evidence, do you need to perform anything extra? Maybe because you were wrong in this case. Maybe because law also requires something else. Or just for the sake of understanding whether the information you have acquired, is it correct information or not correct? You may be required to do some extra procedures other than those which are already written down by ISAs. What are procedures? Procedures basically mean how do you obtain evidences that something recorded by the management, is it correct or not correct? So we will also study these procedures, but not within this chapter. We will look at it in the next chapter. This concept is known as professional skepticism. Now, as a student who is going to give their exams within the next attempt, I would really like to urge you that you should learn this thing and learn professional skepticism, and on the other hand, also learn every single thing that is written for performance materiality. When I say learn, I obviously mean you have to learn it. Close your doors, sit in a quiet room, pick up these notes which I've given to you and start learning them. Start learning them so even the walls can hear you. Start learning them by heart, that you remember every single thing. Conceptually, you may remember them, but theoretically, you have to write it down word by word within the exam. All right? And obviously, guys, when I say learn something out, I know that these are free marks within the exam. Technical portion is not free marks. You have to use a lot of part of your brain. But when I talk about theoretical parts for 3, 2, or at least there will be 10 marks within the exam that will be completely theoretical. So those 10 marks are, this means that those 10 marks are free marks. They are free scores. You can easily get those marks if you learn these things. No technique is applied there. So please learn the things that I always ask you to learn. Now we'll move towards the next lecture. This lecture is going to end here. If you have any kind of questions, then do let me know so I can resolve those questions upon WhatsApp. Thank you so much. Take care. Tata. Bye-bye.